Happy Monday, and welcome to the end of week review for week one of 2026, which is right here. Which one? We do a little bit special for week one because week one we were out for vacation and we don't do recording or take screenshots, so we just use the opportunity to do review for 2025 to see what we learn, and then we go into the new year. So we do this in terms of like a perspective. So all right, let's do what we review all lesson we learned for 2025. Keep in mind, for January 2026, we have week 1, week 2, week 3, week 4, and week 5. So we have 5 weeks. And the last week, the final week, which January, we have Apple MNC in 28 and 29 right there. 27 or 28. Yes, Tuesday and Wednesday. All right, let's see what lesson we learned for 2025. So in the episode, we're going to discuss 3-4 breakout type that we are trading, and we learned it from 2025, and we combine that with a liquidity understanding. So basically, liquidity run from external liquidity run to internal liquidity run, and it go back to external liquidity. So it's very simple. So let's review 3-4 breakout type that we are trading for 2025. All right, here's we try to capture or summarize or simplify the first 2 types of breakout. Is type 1 and is type 2. So the type 1 is on the left side and the type 2 is on the right side. And on the top is the short setup, and in the bottom is a long setup. So basically you need this 3 steps, right? You need a break, a test from above, and then I reclaim or reverse right there. That's it, type 1 right there. The test from above can be 1 or 2 or sometimes 3 candle. When it build up that liquidity, then the reclaim happen very fast and furious right there. In contracts, for the long position, is similar right there. It's break, a test from above, test from below, and then it can reclaim or reverse right there. On the left side is the type 2. The type 2, it can test first, and you see it's mainly for continuation right there. Test and reverse right there. So we simplify that, and we observe that for type 1 is mainly happen largely. There are always exceptions, right? But it largely happen on the reversal side. For type 2, it mainly happen for the continuation. So you look at the detail that we draw there is continuation. It will be a neck leg down or a neck leg up right there. And here's the reversal. It can happen in the context of double top or double bottom. And we overlay that with a 3 setup right. It is the 4 breakout type 3 right here. Here's 4 breakout type 3. So basically for a type 3, you want is a level can be a low time frame level or high time frame level. The best scenario or the best reliable, the most reliable setup, when you see that the low time frame and high time frame have very close proximities, very close together, then you have a high setup right there. So basically, if the short setup, you want to break to the upside at least 3 times right there. Sometimes 2 is good enough. Create a double top right there. The minute you thought it's gonna make leg up, that's where it gonna reverse. So keep in mind that we are number the break to the upside, which is the sales liquidity engineer or build up as a op number 1, and then you have number 2 is reclaim right away. So that's the reason why we go with op number. But later on, you can see a large example. We don't, we don't label the reclaim, move, because we assume it's already there. So we don't have to. We want to keep it easy, readable. We don't want to too much drawing. So that's the reason why sometimes we keep this reclaim step right there. But for the definition of the setup, we put all in there. And that's a short setup and the long setup similar like that. And sometimes you don't need the liquidity right here to switch. You know that there are a pattern right there. The minute it come down right here, it's gonna make it look like a neck leg down. That's where exactly it flips into reversal. So that's type 3 right there. So basically that's a 3 setup that we trade. Yes, 3 setup that we trade. Let's review the definition of liquidity. I think ICT says the best, but this guy he also repeats or regurgitates what ICT says. So right here you see that here's the guy, he posts on X or YouTube, Twitter right there. So basically he say that he just regurgitates what we already learned from ICTs. Basically it go from external liquidity, external right there, the which is stop loss right there, and it fill the gap, internal liquidity, and then it just keep repeat right there. So external liquidity, which is all the high and the low. Internal is where the fair value gap and the price gonna return there. So the price gonna move from external liquidity one to internal one, and then go back to external one right there. But right here make a 1 point right here, and he say that sweep the high, fill the gap below, and then sweep the next low. That means he make 1 extra sweep in order to go another leg up, or this is the finish retracement right there. So that's one of the things that he add into there, which just makes sense. So that's the only pattern that we focus. The rest is just noise, which is correct. So he point out a very good point right here. So the point first that we have to go with the algo, right? And he say that his very true statement that the trading industry, they try to sell you the complexity because that's where they sell across. But actually the trading game is very simple, which is the liquidity. Just about liquidity, if you understand that. And here's he make a very good, very valid point right here. Is also that the market is not random. And it's not manipulation either. It's simply a very neutral. It's just the price delivery system for the one who run the markets, which is the market maker. They want them, they just program the algo to do the price delivery, right? Because the end of the day, the people who run the stock markets or the financial markets, they just collect the transaction fee. They don't care about whether the buyer or the seller. Regardless of the buyer seller, they always have to collect the transaction fees, so they make money. So that's the reason why they want to generate as much as transaction as possible. So they are very neutral system, right? And the reason why we don't take this as a manipulation also, because it gives the stigma very negative, and it's not good for our mindset. Because when you go into the trading, your mindset have to be neutral. You don't want it to be negative, and you have a stigma on that, then it's very hard for you to stay neutral and trade to see the market as it is, instead of give a stigma to this, like, oh, it's market manipulation or something like that. Don't look at that way. We used to be look at that way, because when you try to negatively word your perspective, keep in mind our word is an energy. If you want to raise up your energy, you have to raise up a positive energy, so can keep your mindset is level up. If you have a negative or too much stigma to the trading, which is the journey that you are embark on, then it will not reveal much, fruit for you, or produce a positive outcome for you. So you have to stay neutral, stay positive. That it's just a game, right? You should not think it in a negative way, take it in a negative way. It's just a game. You have to find out where the rule of the game, and you just follow the rule, you will win. Remove your stigma or emotion about that. It's just a game, right? The algorithm is just the AI. It programmed for efficiencies. It programmed for the best price delivery. Regardless you are, who is participant, it doesn't care you are retail or a institutional, big institutional trader. It doesn't matter. It just go where the liquidity happen. If we see a balance in liquidity, let's say more buy sell liquidity, then it's gonna go up, and if see more sell liquidity, then it's gonna come down and grab some sell liquidity. So that is the rest is just the noise, which is correct. So the framework is very easy right here. The price always move from external to internal, and vice versa, and it keep go through the loop right there. So very good for us to review these two core pillar for our trading right there, right? Two core pillar or framework or leg for our trading system right there, which is we trade on the three setup, and then based on the understanding of liquidity, that where we're gonna trace where direction it's gonna go, the algo gonna roll right there. So that's the whole idea of we do the end of week review for week 21. Week 1 of 2026 right there. Alright, so now let's do some high or typical assemble for type 1, type 2, and type 3, and how we read the liquidity, right? Alright, let's go to some typical assemble. Alright, take a look at this sample for breakout type 1 reversal. So here's our 15-minute time frame, which is the time frame that we trade on. So basically you see that when the liquidity move, check the low. So whenever you see the Dow close printing that, you know that it built a lot of buy sell liquidity up here. People sell and put their stop loss at that. That's where they build. That's where the algo is built the buy sell liquidity in order to go up. And here we can see that the level, right, 42, 54.25. Yes, so this level right there, which is this candle, the last the candle just before the reversal happened. That's the key level right there. And like we say that it kind of very close proximity to the high level, which is the weekly and the daily level right there. You see that? Yeah, that's the weekly and the daily level right there. It does. Yeah, that's the daily level. You see that the daily level just above that level. You see that? Just above that level. That where you can see that the reversal is forming. It's a type 1, right? You break the level, test from below and reverse. And in this case, you can see very subtle that it break the low of the candle, which is a sell side liquidity, right? It break the last sell side liquidity before it reverse itself. So every time it go down, it rate the sell side and build the buy side liquidity. Basically the imbalance right there. It tries to create the imbalance in the buy side liquidity in order to go up. So that's an idea. I mean, it takes like 2 years to understand the concept of the liquidity. I mean, at first when we read about we watch the ICT's videos and read his material and all kind of that, the liquidity is kind of foreign language or foreign concept to us, but it takes us around 2 years to practice and understand. Now we can understand what it means buy side liquidity, what is sell side liquidity right there. So right here you have a long setup for type 1 right there, and you can see right there. So it failed to rate the prior day low on Monday. It tried to rate low, but it failed because there are a order block on the high time frame, which is we use a 4 hour, 1 hour right there. Yeah, here's the 1 hour, right? So like we say that, you know, it for the last rate, it doesn't have to rate this low. If for this, it fall into, if you look right here, you can see the failure gap right here, that level. So as soon as it break down to that level, it reverse right away. Then it gives you clue that it's gonna be a 4 breakout right here type, you know, break 1 and break 2 reverse. That is type 3 right here on the. So you always see the overlap between type 1 and type 3 right there. That's where you're gonna have a very high quality setup. So in this case, you see that it break 1 this level and break 2. 3 will be better, but if we see that the liquidity right here, the sell side is rip the sell side liquidity, and it leave this one alone, so you know that it's a quality setup, right? At the beginning of this journey, we always want to see this, to rate this, and we end up mix a lot of trade. But now we understand that if we put the trade type 3 in here, you can see it makes sense. It does not need to rate the liquidity sell side right here, which is low. You only see the failure gap, and you see that it break 1. In this case, only 2. But in this definition, we want another one like down right there. But in this case, actually, yes. If you watch a bit level, you can see that only 3 break to the outside, 1, 2. But if you look at the level, you can see multi break down to the outside. You see that? Break 1, break 2, break 3, and definitely when it go here, it's gonna be 4 breakout. Type 3 right there, very clear right there. But if you watch at this level, you only see 2 double bottom right here at that level. And that's how it manifests itself from high time frame to low time frame right here. And in this case, it happened at 11 a.m. Right there. So that's one of example of Taiwan. Let's look another Taiwan reversal. In this case is a short setup. Let's see if we will find short setup. All right, here's a very typical, very good example of a 4 breakout Taiwan reversal. You see that? That's it. The reversal happened. It's happened at 10 o'clock. You see that? So if you mark that level, it break at that level, it tests from above, right there at 10, and then boom, 10:15 it reversed. And you see that's how the liquidity is built up. All right, you see that right after London, it keep build up all the sell side liquidity right here, and that means the buy side liquidity, like it keep going up in order to build sell side liquidity. So at this level, it tells you that there's liquidity imbalance right there. That's mean more sell side liquidity than the buy side liquidity. And before it got reversed, it got flipped, it gives you the signal, which is tap from above. In this case, you see that it twice, tap from above twice right there. Then there is also or reclaim is forming right there. So that is example of type 1 right there. Let's look one more example, and then we go to type 2 and type 3 and so on. Here's a beautiful setup, and it happened in this case. We have both. We have the confluence of both, which is the setup by itself, the type 1, and then you have the time, which in this case is at 9:30. All right, and the level right here is the one on high time frame, which is the daily. We annotation right here. D1 is means for daily. So it's 4 breakout right there. It's a reversal. It break, test from above, boom. You see a huge move right there. And this is happened on December 19 right there, which is last year. December 19, that's for, is that a Tuesday or let's see what we have right there. So oh, is that December 18? Actually, it says right there. It says 15. 15, huh? Yeah. So it's a December 15. I mean, surprisingly, December 15 is fall on Monday. And we anticipate the beautiful move gonna be in the midweek, but in this case, it's Monday. Right off the bat, it gives a beautiful setup, and it makes sense because Monday it create a gap up, and it create the high, London high, one more time before it reverse itself. So it gives you some idea that right, that exactly the liquidity that we're talking about. It go rate the external liquidity, and then it go back to internal liquidity, which is the fair value gap. In this case, it's the gap up right there. So you have a perfect setup, everything laid up. You have the setup itself, you have a time, and you have liquidity. So that's beautiful setup. You couldn't ask for better setup than this type 1 right here. All right, so we went through 3 examples for type 1, and now we go with type 2. Let's see. All right, let's take a look at the very first example of the type 2. And like we define or like the observation we have for the type 2 is that is largely happen in the scenario where it's gonna make the neck leg up or leg down. In other case is a continuation. Remember, price only do two things. It's gonna reverse or it's gonna be continuation. And we observe that says that largely the type 2 will be happen in the continuation. So you have a gap up right here, and that's gonna be it's gonna be retracement, go down to fellow gap, or it's gonna be continue to make a leg up. You remember the case before with the type 1, remember it go down and reverse. But for the case 2, in this case, a continuation. You see that at right there. You see that level is break, right? It tests from above first. It break, right? It's type 2, so it had to be test first. Test first, right? So right here is test first. Test 3 times. I mean, you can categorize a type 1 also, but in this case we go with type 2, but sometimes it overlap right there. So in this case, test from about what, 1 to 3 times, and then the minutes it break, people gonna go and thought that it's gonna be a breakout to the outside because there are a fair gap down here. They go short, but the minute they short, it flip right away. And this happened at 11, and you can see that that's the 9:30. You see that it's very different. In order for it to be refill the gap, you see this had to be go up real hard, like the previous example we show related to type 1. Not this one. Yes, right here. The same idea, right? This happened. You see the gap up right there, and then you see the huge build of liquidity. In this case, it did not build up. You see that it's just around the open right there. This way, it's way beyond the open range. So it's still in the open range. You see that? That's the difference. You know that even though they all have the same characteristics right here, which is that gap up. In this case, the gap up, it continued to go up right before 9:30 to build up all the south liquidity, then boom, it reversed. It go back to internal liquidity. But in this case, it did not go to internal liquidity right away. How do we know? We know that when the 9:30 open is still in the range of the opening range right there. That gives you the clue that it's gonna make a neck leg up. It's not gonna go back to. Basically, it try to be more south liquidity. So that's the trick right there. So the understanding of liquidity, the difference, give us a very good setup. In this case, it did not fill the gap right away. It may be the day following that or at the end of the week. But it largely gives you the idea that how the type 2 play out right here. It's very clear, right? Test first and then break and reverse, make a neck leg up right there. And this huge move in the PM on that day, which is October 31st last year. So you see the difference right there. There are gap up. How do you know the gap is gonna refill right away? You see that is way above. Right before 9:30, the price already continued to build up south liquidity above the opening range. Then you know they're gonna refill the gap right away. But If it did not do that, it's still in the London range and open range, then you know that a neck leg up gonna be taking place. So give you some bias right there. Alright, now we go to a second example of type 2. Let's go for a short setup. Right, this is the neck leg up. We wanna see if a neck leg down. Alright, here's a second example for type 2 neck leg down, which is a continuation right there. A beautiful setup right here. So you see this is the high time frame level, and here's our low time frame, very close proximity right there. And you see how it formed, right? You see its first leg down, further gap, another leg down, further gap, and then boom. When you go back up here, what you see that right there, test from below, break, and then boom, reverse. That's your typical signature of 4 breakout type 2 right there. And look at the 930, it gives you some signal. So don't short chase right here. You chase right here, it come back, it rip you up, and then boom, it goes to your direction. So be patient right here. You have to be extremely patient. You have to be extremely patient right there, because you know that it's gonna come down, because you see there's all liquidity that it built up sell side right here, and at 930 it already low bid level. Basically this is gonna go down here, it rate all the liquidity, but it don't have enough liquidity yet, so that's which way it try to build more liquidity sell side, and you can see that all the sell side liquidity right there, and wait for what, you know, the right moment with the 1040 buy, and then you can strike right there. But if you look carefully, you can see that definitely right here you see the overlap between the last leg right here, the last move right here is type 2, but if you look a larger picture, you can see it's overlap with the type 2, excuse us, it's type 3. Remember, it's type 3 is a double top right here, right? You can see the top 1, top 2 right here, or top 3, or you can call the whole thing right here is head and shoulder in a layman term, or is in the classics term they call head and shoulder right there. And if you mark this level, what you see, no, let's mark at this level. Let's do a little bit analysis right here. So here you go, we do a little bit analysis right here. Let's say you mark the low right here, you can see another this level. All right, okay, so if you see at this level, what do you see? You see there all right, yeah, let's do this level, it will be much better. If you can see the level right here, yes, so that level will be better. You know why? Because you want it to be see the 4 breakout. So it's break 1, you see that that's another overlap right here, a nested between type 3 and type 1 right there, which is a very high quality. So you break 1, right, you break 2, and then boom. Let's call the code a little bit different, so we don't want to overlap with the type 2. Want to see the type 3 right here. So you break 1, all right, you break 2, and then boom, you break 3. The minute the people on an orbit trade say that, oh, we're gonna make a neck leg up, that exactly the moment it flips. And it gives you all the hint right here, fell gap down, flip gap down, and a huge liquid run right there, and the 930 tell you that it's gonna go down right there. That's where you see the overlap between type 2 and type 3 in this case. It's perfect alignment right here. It's so beautiful alignment right here for the two set up together, and then you have a high quality, and you're gonna aim at the liquidity down here. Right. It already run off the external liquidity, so it don't have to run again. So that's where you see the high quality setup right there. Alright, so we give very two good example on type 2. Let's go for type 2 one more and then we switch to type 3. Oh, here is the example number 3 for type 2, which is a continuation and the next leg up. Right, you see this at first leg up and this is retracement and boom, make a second leg up. And look at this retracement, a little bit tricky because it's 2 leg retracement, right? First leg down, second leg down, finish retracement, boom. And you can see very clearly here at the level, which is the open range right here. In this case, it's low time frame level. So the level is very objective, I mean very subjective. And that's the nature because we are trading a discretionary trading, so it's very discretion. So you're not gonna find a universal level. It depends on how you look at that. So that's the nature of discretionary trading right there. So if you mark the level, you see it test from above twice, all right, and then it break it, and then a minute break, it reverse, it make a second or the next leg up right there. And you can see the 930 beautiful set of the tone right there. So the people thought that, all right, you know, it's gonna be a sell-off day, but it did not happen. You see that it's so beautiful light up right here. You can go in at that level, or you want to wait at the 930 range right there, lower range. You can go in also. You can catch a huge swing right here, neck lay up right there. That is the type 2, you know, continuation. But if you look a little far to your left, you can see it can overlap with the type 3 right here. You see that? So that level, it break 1, right? It break 2, and the minute you thought you're gonna make a leg down, then boom, it reverse. So it's 2 right there. It overlap also if you look on that way. And keep in mind that, you know, sometimes we see the gap up, it's not gonna go down and balance right away. It continue to run to be more sell liquidity before it go back to the gap. All right, take a look at the number 1 or the first example for type 3. In this case, is a reversal. Right, you see that the down move right here, make another down move right here, and this is another down move. It wipe out 3 of this low, which is a sell liquidity. And you see right there, if you look at the level, this is a high time frame level, and it's very close to a very close proximity to the low time frame right here, which is the candle range, the low range of that candle. You can see that it break 1 and break 2. The minute you thought on a neck like that, it flip. That's the nature of the type 3, which is very effective. You can go in at that level of this high time frame level, also gives you a full breakout type 3 right there. At this level, even better. Break 1, break 2, 3, 4, 5, 6, 7, and the minute you thought it's gonna come down, it flip on here. You're gonna see that. That is where it's gonna reverse. You see that? So you catch the move right here. You go back to the 930 open, then you get your money. So that is the first example of the reversal for type 3, and now let's take a second example. Yeah, before we go to the second example, here's the thing that we want to share. Remember, our job as a trader is waiting. 90% is waiting for the entry, waiting for the hit targets, right? So the waiting, that's where the consistent, the patience, and the wisdom grow right there. Don't take unnecessary and low quality trade. That's the huge lesson we learned for 2025 right there. You don't have to accumulate a needless loss right there. Alright, let's go to the second example. Alright, here the second example is very beautiful example right here with it matches exactly the definition of the 4 breakout type 3 right there. It's break 1, break 2, break 3. The minutes it make it look like the neck laid down that way flip on you right there, and you can see that it perfect alignment between the high time frame, with it in this case is the daily, and the low time frame, which is the 15 minutes. So they are very alignment. They're very aligned and they are close proximities. That's the beautiful setup right there. At the level 58.30 and a low time frame is 826 right there. Boom, you go in. You have to wait for the third leg. Otherwise you go earlier, you're gonna get stopped out. So you see that how beautiful is alignment. And right here you see this is the last block right here. I think that's what ICT call is order block right there. And you see that it does not need to rate this low at all. It don't. And that's the missing piece of the puzzle. When we start this journey, we thought, oh, we'll have to wait for it to go all the way here to rate all this sell side. It don't. As long as you identify a level up there where it's gonna create the 4 breakout type 3, then you're good to enter it. And the long setup in this case. Alright, so that is a sample number 3 for the 4 breakout type 3. Now go for one more sample and then we can close up here. Alright, here's example number 3 for the 4 breakout type 3. In this case, it's a double top pattern reversal. And you can see, so we give a very detailed right there. So the number 6 is where it thought gonna make leg up, that where the 4 breakout happened, and it happened at 9:45, which is very critical time. So around 9:39, that's good right there. The minute you thought it gonna flip leg up, you're gonna know that it got flipped. See that? That's gonna flip right there. And that's exactly happened. You see that? It flipped right away. So you know this key level and high time frame right here. You see it test from above, give you signal right. You can go anti short right there. And that's what it happened. Boom. You see that? It go down. And the target is the liquidity right here. And you see that the day that the huge sell side, a huge buy side liquidity right here, it built up for the prior day, then it ripped that buy side, and then the minutes it ripped all, then it go down. It ripped all the sell side right here, right? All the sell side really built up. Beautiful setup. You see at the 9:30 right there, and also you look at the 9:30, you can see that it's proximity to the high time frame right there. So beautiful lineup. So you short entry at 11:15. That's your level right there. And here's the perspective from the one. It's a daily, right? It's the daily level right there. And right here you can see that this candle is right in this. It's just a they call inside bar right there, and it tests from above twice. You're gonna anticipate that day it's gonna flip, and it did flip. You see that it closed at that level. So the high time frame gives you a bearish bias right there. All right, I think that's good for week 1 of 2026 and a quick review. So basically we just review what we have in our arsenal, in our trade, because the first week of January, we only have 2 days and the holiday right there, so we don't record, So we just want to use this opportunity to review what we have learned so far 2025. So we hope you enjoy this end of week review, week 1 for 2026. We're always grateful for this opportunity. We do what we love and success is coming our way. Day by day, little by little, in every way we're getting better and better. Thank you and talk to you soon. Bye for now.